Does anybody still care about U.S. inflation numbers? Do they still have the capacity to move markets? Or since we've decided the Fed is done raising rates for good, then maybe we've moved past it and maybe we don't care. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And the first part in answering this question would be to know whether inflation is going up or going down, which sounds like it isn't a controversial kind of thing, but it does depend. What we're going to do here is we're going to take a look at what's actually going on here, whether it still has capacity to move markets. Spoiler alert, I think it does. And see how this might develop then once the numbers hit the tape tomorrow. As ever, if you're watching this on YouTube, jump into the comments. Let me know what you think. Does inflation matter? Is the Fed going to hike again? Maybe cut sooner, later? It doesn't matter. And then we'll take your comments and incorporate them into the show. By all means, feel free to ask questions too. We'll incorporate those as well. So, what is going on here with inflation? And is it going up or is it going down? And what's actually occurring? Well, here's a sort of one glance picture. This is the core CPI there in the dashed line, the headline in the solid line. Expectations there for an uptick, second one in a row, for the headline up from 3.2 to 3.6%. The core there, as you can see, seen going down still to 4.3%, which would be the lowest reading since September of 2021. So we're nearing a 2-year low. And there's the components. So the first question that immediately comes up is, well, is inflation going up or down? Well, the headline is going up, but the core is going down. What is the core? It's the headline number minus food and energy. So minus those bits there in the blue and the yellow at the top. Well, if you look at that, then it seems to be going down. And the goods part of it seems to be negligible at this point. So the main thing there seems to be services. Services inflation, the biggest component of the pie, and also the pie that the Fed is most acutely focused on, because it is the most significant one, that one seems to be going down. So what's going on with headline? And is that anything that we should be worried about or that the Fed is likely to be worried about? Well, it's either food or energy, because core excludes those two. So what's going on there? Well, it's probably not food. If we look at agriculture commodities here, they've been basically idling through the period that we're talking about here. So it does seem to be energy. And when it comes to energy, it isn't natural gas, it's oil. We can see very clearly here, natural gas has been idling, having absolutely plummeted after the initial spike at the onset of the war between Russia and Ukraine. And crude oil is where we've seen the recent action. So looking back at this, should the Fed worry about it? Well, maybe not, because what's the Fed going to do about the international price of crude oil? Not a whole lot. Ostensibly, it is already raising global interest rates. It has already raised them quite a bit. That will and has been a headwind for global economic growth, and that will impact crude oil demand eventually. These most recent gains seem to be more about the markets believing the story that OPEC can successfully cut output and stick to it. The latest idea is that Saudi Arabia is going to trim output by 1 million barrels per day. I, of course, remain skeptical, as I've discussed on this show extensively, because even if they do that, other OPEC producers will likely step in to offset the gap. They tend to be overproducing their quota by about 3 million barrels a day so far this year, and 2.5 million barrels a day historically since they started having this quota back in 2014. So we probably don't have that much to worry about there, but in any case, even if we did, there's not much the Fed can do. Energy over recent months has actually been a negative impact on the price growth trajectory here. And so a bit more of a positive impact is perhaps not the end of the world. It's getting down that core services number that really needs working. Now, the biggest component there is actually housing services, which for the most part is upkeep of homes by owner occupiers. And here the Fed doesn't really have much of a chance to have an impact either because of a situation that, for the most part, it has wrought. So if we look at the outstanding mortgage rate on current mortgage debt, so debt that's already out there, mortgages that are already out there, it's 3.6% on average. Whereas if somebody were to go out and try to get that same 30-year mortgage now, it would be something like 7.6%, largely because of the Fed's aggressive rate hike cycle. Now, if you've locked in a mortgage at 3.6% on average, are you going to sell your house? Probably not. Because the other mortgage you are going to have to get for whatever new house you're going to get is going to be close to 4% more expensive. So not surprisingly, people are going to do everything they can to not move. So there's going to be increased costs of upkeep for existing homes. People are going to try to stay in their homes as much as possible and as long as possible because they want to avoid moving as much as possible because it's really expensive to finance that kind of a change. In fact, the inventory of existing homes has absolutely plummeted and is now barely a hair over 1 million homes. And by the way, existing homes, in terms of overall U.S. housing activity, outnumber new homes, existing home sales outnumber new home sales by close to a factor of 6. So it is about existing homes, even as building activity picks up a little bit. So there's not a whole lot that the Fed can do here because its own rate hikes have basically made this market completely liquid. Nobody wants to sell. Everybody wants to stay where they are, and so housing inflation is probably stuck for now until the Fed can start to back away on rates. That can, over years, because the housing market is slow, filter through the housing market, bring down mortgage rates, and bring down housing costs, and eventually unstick this part of the inflationary puzzle. But that's not where the Fed can have near-term agency, such that it could get to a 2% inflation rate in 2 years' time, let's say. That leaves the labor market. And we've heard the Fed loudly say that this is where it's focused. This is the part of inflation it hopes to impact. And we can see why this is sticky and that it is sticky. Take a look at how much CPI has gone down. Take a look at how core CPI has gone down. Headline has gone down from 9.1 to now sub 4. Core has gone down from just under 7 to just over 4. Meanwhile, the employment cost index has only gone down from 5.1 to 4.5, less than 1%. And so it's very clear that there is a stickiness in wage inflation here. It's not difficult to see why. The bars that you see in the blue there are representative of the surplus or deficit in labor supply relative to demand. And what you see now is that we are still very much in deficit to the tune of nearly 3 million jobs. there was obviously a large surplus that jumped there to nearly 17 million at the heart of the COVID onset, because the economy was closed and there was no need for workers because businesses were shuttered and nobody was going anywhere. As the reopening started, more and more people came into work, so there was less and less surplus, and somewhere as we got into 2021, it started to flip to deficit for a whole host of reasons: a skills mismatch, early retirements of baby boomers through COVID lockdowns, et cetera, et cetera. And so where we end up now is still a significant shortfall that, not surprisingly, has employers competing for scarce labor on the only dimension that they can, on price, on wages. Now, we can see here the Fed has had some success in cooling this a bit. We're in from about 6 million shortfall down to close to 3, so we've cut it in about half. Things are heading in the right direction, as it were. But there's more work to do. So as we see headline come up for oil-related reasons and core coming down, what do we learn? Well, if the Fed can't have agency on the housing side of this, then chances are what a weakening core inflation number is telling us about is a weakening labor market. That thing that the Fed has been trying to achieve basically since it started this rate hike cycle in March of last year. And of course, the Fed has been saying all along that it takes about 12 to 18 months for a single rate hike to fully filter into the economy, which of course would mean that we should start seeing the meat of the cumulative impact of tightening right about now. So it is starting to happen that the meat of that tightening cycle, that 75 basis points back-to-back stage that we saw toward the middle and a little bit past it last year, that should be the pain now arriving, give or take, between now and the end of this year going into early next. So what this divergence is perhaps telling us is the Fed is having some success. It is getting the pain injected into the labor market that it wants to inject. And that this labor supply imbalance has been coming in is testament to that. Now, in fairness, most of it has come from reduced job openings, not from layoffs. But if this continues, then the layoffs are ostensibly coming. So what this means, probably, is that the Fed can look at this data, look past the headline number going up and say, you know what, we don't need more rate hikes because this is working. This is doing what it needs to do. So if you look at expectations, you now are looking at just a bit under 50% chance that the Fed is going to hike again this year. Latest is a 48.5% cumulative chance that we get another rate hike in December, or by December, I should say. Note that when we look at it meeting by meeting, there's a paltry 6.8% shot of a hike at the September meeting, a 35% chance that the hike happens in November, and if it doesn't, a further slight chance that it happens in December. For a cumulative 35 plus nearly 7 here is nearly 49. So, what does this tell us? That if the Fed doesn't hike in November, it probably won't. The cuts then begin to enter the picture in earnest in June, and by August, there's already one that's baked in. By September, there's 2 that are baked in. By December, it's 3, with about a 45% chance for a 4th, which is already fully in the outlook by January of the subsequent year. So let's say we get these CPI numbers as expected. What does that tell us? Well, the Fed probably doesn't need to hike again, so that would endorse what we already know here, what's already, for the most part, priced in. Doesn't really tell us much about what happens at the back end, but certainly seems to endorse the idea that we might need cuts. And here's where this gets interesting. If this is the part where the Fed can actually have an impact, and that impact is being had as testament to core inflation going down, what that means is the Fed has successfully started to hurt the labor market. But of course, that also means it has successfully started to lay the foundations for lower consumption, and consumption is 70% of growth. So it is then starting to push the economy much more potently in the direction of a downturn, making these cuts start to make a lot more sense. So, does the Fed still care about what's going to happen between now and the end of the year, or does it care about those cuts? Well, the recent price action would suggest it doesn't really care about what happens this year at this point whatsoever. Note, the gray bars here are the difference between the Fed funds futures implied rate for the Fed September and December. So essentially that captures how much rates are expected to move this year remaining. And what you see is we've fallen well short of baking in a full 25 basis point move. We're hovering around a 10 basis point move. So that's that slight chance, a little bit less than half of a rate hike. But the key thing here is this hasn't moved now for nearly a month. Each one of these clusters of bars is a week. So that's 1, 2, 3 weeks and about a half now as we head into the midpoint of this one. And what you see is expectations for near-term policy are a bit steady, not really going anywhere. And in that time, prices have gone up, and now they've come down on the benchmark S&P 500 stock index. So there was nothing in those near-term expectations that ostensibly did that because they didn't really go anywhere. At the same time, again, same standstill on the near-term policy outlook, but the dollar has been raging higher. And so what does all this mean? Well, perhaps the market cares much more about those cuts and the reason for them, which is how you get a stronger dollar and weaker stocks, even though near-term policy expectations haven't changed. The dollar tends to benefit from risk aversion. It tends to benefit when markets go into liquidation mode because it is the liquid cash of choice to liquidate into more often than not. And so in a period where we've had stable policy expectations, it has gone up and stocks have gone down. That is a defensive posture. It is a defensive posture that perhaps reflects that the Fed's success here comes at a time when global growth is already near standstill, as the pop to service sector growth globally at the beginning of this year unravels. Notice that since the beginning of the year, we've had a very spirited jump in service sector growth globally. This data is now up to date through August. And in May, that seemed to crest. Manufacturing, of course, has been in contraction mode since basically the middle of last year, in part thanks to the Fed's efforts, of course. The service sector had a nice pop, certainly in part because China reopened in December, and that's tantamount to unlocking the largest population in the world out of lockdown and telling them, hey, you can go out and shop and go to stores and restaurants. Maybe even travel around. So the Pickup in services demand, not surprising there. It also seems like folks had some leftover stimulus money to burn through. It seems like there was an uptake to some of the services that people were shunning immediately after the pandemic, that they became more comfortable with re-engaging on, like travel. So there was a bit of a pop in service sector demand at the opening of this year. And by the middle of the year, it was over. And it has now been driven all the way back down, almost, to where we're essentially at growth levels consistent with about the fourth quarter of last year, maybe a little bit higher, a touch higher, maybe closer to the middle of last year, and rapidly converging on standstill. PMI numbers are, of course, centered around a 50 level, where that is neither expansion nor contraction. So as we move lower from higher values above 50 to lower values above 50, we're still in growth territory, but growth is slowing. And as we get to 50, that will be standstill. And if we get under 50, that'll be contraction. And the further we then go below 50, the faster that contraction is. So what does the Fed's success mean in this context? Well, as we've said a lot here recently, global economic growth is 57%, three economies: China, the Eurozone, and the US. And this actually understates it, because much of the rest of world, 43%, looks to those three economies as the source of demand. They are vendors that sell to these main demand hubs. And so actually the influence of these three demand hubs is even greater than the 57% that you see here at face value. And the news is not good out of any of them. And with this data, perhaps that includes the US, increasingly. The Eurozone, which you can see here is 15% of the pie, is ostensibly already in recession. We've already seen 2 consecutive months of negative growth in the PMI numbers. That follows a negative GDP reading out of Germany in the second quarter. So to put 2 and 2 together here and suggest what's been happening in Germany seems to be spreading region-wide, probably means they are, if not already in recession as a region, then certainly just a hair away. The situation in China is relatively dire. We're again sinking towards standstill here as that pop in services at the opening of the year unravels. These are official Chinese PMI numbers, but if we looked at the private sector estimates from Caixin and S&P Global, they tell a very similar story. So set aside any dubious and skeptical thoughts you might have about the veracity of Chinese economic data, because whether you look at the official numbers or the private sector ones, they basically tell you the same thing in this case, with only slight level differences. So China can't seem to get off the mat because, of course, manufacturing never returned and the pop from the service sector fizzled. Much of the reason why that manufacturing sector never returned is China opened after the export demand from its main customers, the US and the Eurozone, had long since dried up, mostly because the pop in catch-up growth after COVID happened over a year before China reopened. And because of that, there's been a very brisk effort to change supply chains while China was closed, but supplies of things were still needed. That, of course, is a big part of why we have the inflation that we had in goods. There's been an absolute race to change those supply chains, and not surprisingly, Mexico has quickly become the largest U.S. trading partner, bigger than China. because of nearshoring and friendshoring and otherwise reshuffling of supply chains away while China was locked down. So when it did reopen, the demand was just not there like it was in the pre-pandemic years. So after that service sector bump from reopening got spent down, well, we never really went anywhere. And of course, what all of this targeting of the labor market means is that the Fed is actively taking the axe to the last big slice here, that 24% that is the US. Because if you start to really squeeze the labor market, well, but it's not long until you squeeze consumption. People need jobs to have money to buy things. And consumption is 70% of US economic growth. So what does it mean that the Fed is having success here? And core inflation continues to go down. Well, it may well be that the takeaway for markets from this is forget what's going to happen at the next policy meeting or the one after or the one after. What all of this means is not encouraging in that the Fed won't move on rates, because we expect that already. That's priced in. Instead, what matters is that the Fed is slowing the last bit of the U.S. economy and the last portion of the global economy standing in the way of global recession. And a global recession would be decidedly bad for earnings, would be decidedly bad for cyclical commodities like crude oil for that matter, but also copper, also cyclically inclined currencies like the Australian dollar and the Canadian dollar. And it would probably create a dynamic in bond markets where the front end holds up, because certainly the Fed is in no hurry to cut, but also probably encourage demand for bonds at the long end as haven capital starts to show up there with falling stocks, bidding up bonds at the long end, pulling down yields at the longer end in anticipation of oncoming cuts, and reflecting in a flattening of the yield curve. That should give the yen a bit of a lease on life, as well as gold, both of which tend to be reflections of where interest rates are anticipated to go, globally speaking. And so that may very well be the response here to this CPI data, where the headline number isn't what spooks because it's higher. It's the core number that spooks because it's lower. And that is macro money for today. As ever, we are here Monday through Thursday every week, right after Overtime, a show that I co-host with Chris Vecchio, head of Futures and Forex here at tastylive, where we try to break down the day's events after the Wall Street close and make sense of them and maybe even figure where they might go next. I'm back on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com. In fact, a summary of this very analysis is there as we speak. And opining on Twitter, yes, Twitter, because I'm stubborn, at Ilya Spivak. Thanks very much for joining, everybody. Do jump in those YouTube comments if you would like, and we'll incorporate your thoughts into the show. Happy trading out there. See you tomorrow.